silver around this $50 level, we're now getting in a range where I feel comfortable looking to be a buyer on gold around 3,500. I think that's where the fundamentals over the next year or two start bringing silver back up towards the 90, 100 level, eventually taking out 120. And I still think 150 within by 20, even $200 is very doable. So there's a lot of technical damage. People that bought in at 100 are going to be panicking when it gets back to 100 to dump into that and say, thank goodness I'm back to my break even. That's human psychology. I think what we need to see is a flush out of what I call the weak hands, right? And this goes with gold as well, is that when you had people jumping in because they thought it was a get rich quick thing on silver and gold when it was going parabolic every single day, those people need to be flushed out. And so that's the fear. The fear is it's not the sexy trade anymore. It's got to be dumped. They're going to eventually throw in the towel. And when they do, that's that final flush out. We get a bottom and then we start trading back. I think this, by the way, I think by year end, we're back to $75 to $80. Physical delivery is so important. So don't think that there's no nefarious kind of action going on.
You mentioned the metals. Obviously, they have taken a hit. Last time you were on, you made some of our viewers very unhappy with your call for silver. You called for $50 silver. Silver's at around $56. Again, let's hear where you are on where you see the silver market towards the end of the year, ending 2026.
Yeah, so the key here is, and listen, I know I upset people by talking about it going down to the 50-ish level, give or take. Number one, it's almost there, and I'm starting to get ants in my pants to buy silver, right? So the first key level is this pivot point here at 54. That'll be first support. I don't know if it will hold, but that'll be starting where I start to nibble. And then really at a pierce of $50, that's where I want to buy. Now, the rebuttal I always hear, right, is that, oh, but, inflation adjusted silver should be so much higher. You're 100% right. But remember, folks, silver, gold, that in the short term, things move on emotion, which is right now fear, and that drives price below where it should be. And just like greed, when we were at 120, you could argue that it shouldn't have been up there that quickly. Longer term fundamentals absolutely matter. And so again, obviously I'm looking to be a buyer on gold around 3,500. And we'll look at that in a minute. But silver around this $50 level, we're now getting in a range where I feel comfortable.
Markets may be pricing fear today, but fear has often been where long-term wealth quietly changes hands. As Gareth Soloway points out here, silver approaching the $50 zone is less about panic and more about identifying where sentiment disconnects from value. Retail investors often chase momentum while institutions accumulate during exhaustion phases. If you're protecting purchasing power rather than chasing headlines, emotional selling can become someone else's opportunity. Next, Gareth Soloway reveals why the level everyone fears could become the foundation for the next major advance.
That it's at a discount to where it should be over the longer term, and I'm starting to get very interested in being a buyer.
So you're going to be buying silver as you see it still moving downwards, but where does it go from there?
So I think that, again, you get in this 54 to 48 range or so down in this range. And by the way, where am I getting that lower range? That would be revisiting our 1980 highs as well as our 2011 highs. And just in terms of a quick lesson in charts, when you have a trend line that is hammered on in technical analysis and it finally breaks out, there's this inevitable want for it to come back to home base. Think about a kid who goes away to college and then they come back and live with their parents after college, or they come back for Thanksgiving or Christmas, right? There's just that inevitability that it oftentimes comes back to that level. And that's what silver's doing. Very normal human psychology reaction. After that, we start our next trek up. I think that's where the fundamentals over the next year or two start bringing silver back up towards the 90, 100 level, eventually taking out 120. And I still think 150 within by 2030, 20, even $200 is very doable on silver. Again, I'm not looking for these parabolic moves like we saw here, but just fundamentally, you can make a case that eventually it revolves around that 150, maybe even 200 level.
You're saying $200 silver, but by 2030.
Yeah, and again, when I project out so far, right, 4 years out, 3.5 years out.
The most important signal isn't where silver is today. It's where history says major reversals usually begin. According to Gareth Soloway, revisiting long-term breakout zones is a recurring feature of powerful bull markets, rather than evidence the thesis has failed. Markets frequently revisit old resistance before building fresh support, while impatient investors mistake that process for collapse. Missing that distinction can mean selling near exhaustion instead of accumulation. Next, Gareth Soloway exposes why historical retests often precede the biggest institutional buying cycles.
It's so hard to really know. It could be by 2028, 2029. I'm not expecting silver to just rip up to 120 again after it gets to 50, right? There's a lot of technical damage. People that bought in at 100 are going to be panicking when it gets back to 100 to dump into that and say, thank goodness I'm back to my break even. That's human psychology as well. When we get crushed on a trade, we're just happy to get out break even, and you will see some of that. So it's going to have some work to do to get back to the upside. But I do think, again, once we get up there to that 120 level and break out, you'll see 150 and 200 very, very quickly again. But again, I'm giving myself a little leeway on this call, Michelle. Let's give it till 2029, 2030. That's really only 3.5 years away. It's not that far away.
I will give you some grace. You also say that you're right 70% of the time. Isn't
Right.
that your statistic? I mean, maybe this is the 30% of the time that you're not right. We'll
Absolutely
see.
could be.
But on that note, help me understand why the fundamentals here do not drive this higher. Because I get you're looking at the charts and you've got your trend lines and you've got the fear and you've got the greed. But then people will say, but the fundamentals for silver are just not the same as they were in past cycles, with this industrial demand really ramping up. Again, the AI infrastructure, the data centers, the grid expansion, the electrification. I mean, these are not cyclical or optional trends.
The biggest losses often come from investors who confuse breaking even with successful investing. What Gareth Soloway is highlighting is that trapped buyers can become future sellers, creating resistance long before fundamentals fully reassert themselves. Institutional investors understand these emotional supply zones and frequently position ahead of them, while retail reacts. Preserving wealth means recognizing psychology as another market force, not just mining supply or demand. Next, Gareth Soloway exposes why industrial demand alone still cannot guarantee higher silver prices.
Is the argument. Of course, you've also got the photovoltaics, the solar, that we are also in a supply deficit of at least 6 years, according to the Silver Institute. You look at the technicals and you look at the lines and the sentiment, but when do the fundamentals start to override this?
Yeah. And I think what we need to see is a flush out of what I call the weak hands, right? And this goes with gold as well, is that when you had people jumping in because they thought it was a get rich quick thing on silver and gold when it was going parabolic every single day, those people need to be flushed out. The old school, and I, not to date myself or whatever, but those of us that have been in gold and silver since the teens, the early 2000s, we understand that gold is a safe haven. It is meant as a hedge against inflation, against the US debt continuing to climb, and eventually it will play out in the long run. But we can't expect it to go up 100% every single year, right? I mean, that's just not the way it's going to work. So I 100% agree with you. The fundamentals say eventually up, and I agree, and that's why I'm looking to buy in this lower $50-ish range. But at the same time, the fear of people that are stuck in this trade. I mean, think about how many people bought between even just $100 and $120 that are now feeling the pinch, that are getting ready to throw in the towel.
Supply deficits alone have never guaranteed immediate price appreciation, despite what the headlines imply. Gareth Soloway's argument suggests markets first need speculative excess removed before fundamentals can regain control of pricing. That's the contradiction many investors overlook. Strong demand and falling prices can coexist while leveraged participants unwind. Those protecting retirement savings should separate long-term value from short-term positioning. Next, Gareth Soloway unravels why fear-driven liquidation may actually strengthen the next precious metals cycle.
And so that's the fear. The fear is it's not the sexy trade anymore. It's got to be dumped. They're going to eventually throw in the towel. And when they do, that's that final flush out. We get a bottom and then we start trading back. I think this, by the way, I think by year end, we're back to $75 to $80. So there's actually some really good upside in silver here. It's just you got to get rid of these weak hands.
So $80 silver by the end of the year. Gareth, what do you make of the fact that there is more demand for physical silver. And it's not just the futures contract. It's not just the options. There's actual delivery taking place at an increasing level of physical silver, which leads not into that industrial discussion that we had, but also as a monetary tool, which we know silver does have that dual property. And we also have these exchanges opening up outside of the West, in the East, which people are saying, you know, there's been an ability to manipulate the price of silver through these derivative markets, predominantly COMEX and LBMA, and that is no longer going to be as easy to do when you have these other exchanges opening up in the East, and those exchanges are actually resulting in physical delivery. How does that impact the way you're seeing silver?
That's really important. The physical delivery is so important. So many people buy, and now we have these perpetuals on stocks and even on Bitcoin, and it allows people to basically trade the underlying asset without actually owning it, right? I mean, without actually having the physical asset in their hand. And I think that, again, if you could get rid of that, then these metals would instantly be up significantly.
Physical delivery keeps increasing even while many investors focus only on futures prices. And that disconnect deserves attention. This is where Gareth Soloway's thesis shifts from chart structure toward market mechanics that institutions closely monitor. Paper markets can temporarily dominate price discovery, but persistent physical demand gradually limits that influence over time. Long-term investors should watch inventory movement as carefully as price charts. Next, Gareth Soloway reveals why physical settlement could expose pressures hidden beneath derivative markets.
I don't think they're going to get rid of it, unfortunately. It looks like they're trying to. The other thing I'd point out, too, is don't think that there's no nefarious kind of action going. And I talked with Andy the other day about this, and it was fascinating, and I agree with him, is that if you're a central bank, if you're a country, you don't want silver at 120 if you're buying a ton. You want it down. So you're going to do your best. And we still see central banks buying gold and silver, but they would much rather buy it at a discount and load up and get retail scared and dumping so that they can kind of swallow it up. And I could absolutely see that as being part of the issue here. So there's lots of things going on. We see insider trading. I mean, even on Micron, yesterday at 310, it was at 990. And for the rest of the day, it soared back up to 1050. And then miraculously, the earnings popped it to 1250 today. There is insider information leaking out in every which way at record numbers. Not saying it hasn't happened before. It's always happened, but it's so obvious now in the charts. It's at such a magnitude that in silver and gold, I'm sure there's some of that where let's put some negative stuff to push price down with retail, scare them out as we just buy up underneath. So if you're a long-term investor, just focus on the fundamentals. The fundamentals is golden down the road. That's where you got to look.
All right, let's take that opportunity to shift into gold. Another controversial call that you made last time you were on, you saw gold at 3,500. It has broken 4,000.
When the largest buyers benefit from lower prices, optimistic headlines deserve extra scrutiny. According to Gareth Soloway, central banks have every incentive to accumulate precious metals more cheaply if opportunities emerge. While allegations of coordinated price suppression remain debated, investor psychology and institutional accumulation often move in opposite directions during corrections. Wealth is usually transferred from impatient sellers to patient buyers. Next, Gareth Soloway exposes why gold's next move could surprise both bulls and bears simultaneously.
Talk us through your gold outlook right now.
Yeah, so gold, if we look at the chart here, this did come into some key support. So notice this beautiful trend line, high pivot here, low, support, support. Every time it hits this line, it's getting a bounce, and we have this beautiful downsloping trend line. And so what this is creating is what we call a wedge pattern. Wedge patterns squeeze price tighter and tighter until it explodes in one direction. Now listen, if it breaks above this trend line, which currently sits around 4,300, then I honestly might say to you, we might not get to 3,500. We might have broken out. But on the vice versa side, if we break this 3,090, 80 level here, we probably trade down to this major support at 3,500. To me, that would wash out the weak hands that we were just talking about, people that bought gold thinking it was a get-rich-quick meme coin, when in reality, it's an insurance policy against all the crazy stuff we see with fiat and these governments out there. But right now, I'm still leaning towards the downside. I don't think we've been fully flushed out on gold yet. And I will say this, and we talked about this just before we went live, Michelle, is that, you know, once you're below 4,000, at this point between 4,000 and 3,500, it becomes a rounding error. I believe gold is going to 10K, probably at the same time as silver's at 200 or so. And so if that's the case, what does a few $100s mean at that point? In other words, once we're below 4,000, as we go down, I'm just going to have buy orders every $100.
The most valuable decision may not be predicting the exact bottom, but preparing before it forms. Gareth Soloway notes that wedge patterns often compress uncertainty before decisive moves, forcing emotional investors into costly mistakes. Long-term wealth builders frequently scale into weakness instead of waiting for perfect certainty that never arrives. Timing discipline often outperforms emotional conviction. Next, Gareth Soloway reveals the contradiction between short-term weakness and his long-term gold target.
A little bit, a little bit, a little bit, and just start accumulating for that longer term horizon move that I do see coming. And again, you know, how do you not like physical gold? I mean, physical gold is the way that for thousands of years people have said this is real wealth. Governments have come and gone, you know, civilizations like the great Rome has come and gone, and you still have gold as a store of value. So I think from now on, you know, you below 4,000, it's a buy.
How did we get to 4,000 considering we had that astronomical rise in gold and central banks kept on adding to their hoards? And I mean, retail interest, sure, but the smartest money in the world is loading up on gold. Yeah. What do you make of the fact that we dropped to 4,000?
Well, you know, it's so interesting. It's to me, it became a risk-on trade. And it's never meant to be a risk-on trade. We would see NASDAQ up, gold jumps up significantly, right? In fact, if you look at, you know, the highs here, it kind of coincides with earlier in the year on the S&P or the NASDAQ. If we look at the NASDAQ, you know, you go back to earlier this year, we were kind of right up in that upper range too. And so I really look at gold and just say, hey, listen, people again bought it for the wrong reasons. They saw it just ripping, and they bought into the narratives that were being spun, which, by the way, I believe in those narratives. But it hyped up too many individuals to jump in.
Gold has protected wealth through centuries of political change. Yet many investors now treat it like a momentum stock. What Gareth Soloway is highlighting is that when safe havens become speculative trades, corrections become far more severe than fundamentals alone would justify. Institutions often use those emotionally driven pullbacks to expand long-term positions while retail exits in frustration. Preserving capital means distinguishing insurance from speculation. Next, Gareth Soloway exposes why the smartest buyers welcomed gold's correction instead of fearing it.
And again, it was all those reasons, you know, central banks buying, etc. And it just pushed it up too much. And there's this, what we call a rubber band effect in charts, where when you pull that rubber band, the tighter you pull it or the further you pull it, when you let it go, it snaps back. And so if you get a bunch of people to buy into gold at the highs, 5,000 or above, and then all of a sudden the bottom drops out, those sellers then are going to push it down significantly. And I think that's what we've really seen here. We've seen, again, the risk on trade has been deteriorating. We've seen less and less. If you look at the stock market breadth, it's been more and more negative, even though you still have a stock market near all-time highs. We know it's just a handful of stocks at this point keeping the markets up, and gold is reflecting that. Now, eventually, I think gold flushes out those weak hands like silver and becomes a risk-off trade where people start buying it again and pushing it up as the stock market comes down.
Well, we did have gold doing exactly what gold is supposed to do during this war with Iran, where you had central banks like those of Turkey selling their gold in order to be able to support their currencies and finance oil purchases. We saw some gold selling coming out of the UAE as well. So that is what you have gold for, to be able to liquidate quickly and easily in cases of emergencies like that. But what's interesting now is we had this debasement trade coming out from the banks last year saying that people are piling into gold and Bitcoin because of debasement and devaluation of fiat currencies.
Market breadth has weakened even while headline indexes remain elevated, a divergence that has preceded important turning points before. Gareth Soloway's argument suggests gold's pullback reflects excessive positioning rather than the collapse of its long-term monetary role. Narrow leadership often hides growing systemic fragility until liquidity suddenly disappears. investors focused only on index highs may underestimate that risk. Next, Gareth Soloway reveals why the popular debasement narrative may be changing without the underlying monetary reality changing at all.
And we had a curious article coming out from Bloomberg saying that the debasement trade is now fading. Again, that was the trade that pushed investors into gold and Bitcoin and away from the US dollar on fears of inflation, deficits, debt, loose monetary policy, eroding the value of fiat currencies. And according to Bloomberg, the debasement trade is losing momentum because of President Trump's nomination of Kevin Warsh. It says that's when it began to start losing momentum, because Warsh had supported lower rates, but his reputation as an inflation hawk has changed market expectations. And they're blaming or citing that as the reason that this debasement trade is losing some of its shine. Is the trade really dead? I mean, nothing has changed, really. Currencies are still being debased. Why do you think a Bloomberg comes out with that sort of article saying debasement trade backtracking or on hold?
Well, I mean, it's tough to know whether they're, pushing a narrative that is going to drive gold down so that institutional money can start to buy, or if it's just that this now looks like the narrative. But like we talked about earlier, I don't buy that Kevin Warsh is all of a sudden coming in as a hawk. I mean, President Trump is not going to mess that up. Think about what he went through with Jerome Powell. He's not going to put a hawk in there that is not going to do his bidding essentially when the time is right. And so I think that, again, this narrative shift is feeding right into the kind of the flush out the weak hands type play. And that's going to push gold down, which gives me and institutions that I even talk with and such, they're looking to buy gold. They're just looking at this sub $4,000 level. And I think, again, maybe that's part of the issue here is you're getting that narrative flip, which is pushing gold down, but it's just feeding right into the institutional buy side.
The story surrounding an asset often changes long before the underlying monetary conditions actually do. This is where Gareth Soloway's thesis shifts from chart analysis toward questioning whether narrative changes are encouraging investors to sell into institutional demand. Regardless of media interpretation, persistent deficits, debt expansion, and currency dilution remain long-term structural forces that deserve careful attention. Smart investors watch actions more closely than headlines.